Hey everyone, it is Julie here with TipRanks, and today we're taking a look at 3 small cap stocks with unanimous strong buy ratings. So let's get into it. Alright guys, welcome back. Thank you all so much for being here, and TGI Friday. Today, we're taking a look at 3 stocks, all priced right around $10 per share, that have unanimous buy ratings from Wall Street. All 3 of these companies did come to the public market via a SPAC merger a few years ago. SPACs were those special purpose acquisition companies, and they were a big trend around 2021, where we had a flood of new companies coming to the public markets quickly. All of them came to the market around that $10 per share price point. Some of them took off in a big excitement, others kind of fell short and crashed. But we now have a few years of financials under the belt, and with those, Wall Street analysts are weighing in and have some pretty optimistic outlook for the 3 stocks. So we're going to take a look at these companies, what it is that they do, and what those analysts are predicting for the stock's future. Of course, some of these smaller companies can be more volatile, so please make sure you always understand the risk before making any investment decision. Don't forget to hit that thumbs up button if you enjoyed today's video, and make sure you're subscribed to the channel as well. Now let's get into our 3 unanimous buy stocks. First up, we're taking a look at a company called Bowlero. They trade under the ticker BOWL, priced at $11.73 per share. You can see back in 2021, when the SPAC merger was completed around that $10 per share, the stock has seen some ups and downs since then. Over the past year, they have fallen 18%, but are up over 13% in the last 6 months. As the company's name implies, they are involved in the bowling industry. More specifically, the company owns and runs more than 325 high-end bowling centers across the US, Canada, and Mexico, making it the world's leader in bowling entertainment. Furthermore, back in 2019, the company purchased bowling's major league, the Professional Bowling Association, which boasts thousands of members and a global fan base in the millions. Bowlero will be sharing their Q3 earnings report soon here on May 6th. This follows their second quarter, where they did have a much wider than expected loss per share due to some increased expenses. However, the stock did still gain as there was some healthy revenue growth. For their third quarter, analysts are anticipating earnings per share of 25 cents, which would be a big increase over last year's loss of 22 cents. For the second quarter, they did report a loss of 44 cents per share, but they did complete the acquisition of Lucky Strike. Revenue increased 11.8% to $305.7 million, and they added 3 locations during the quarter. The company also approved the initiation of a quarterly dividend program. Their first dividend was paid on February 23rd, and the company intends to pay this dividend on a quarterly basis going forward. One analyst from Oppenheimer weighed in on the Bowlero stock. They said with same-store sales trends starting to stabilize and improve, the firm believes the story has been largely de-risked and investor expectations have been reset. They believe that the valuation is fair, giving Bowlero's industry-leading margins, bountiful M&A and new build opportunities, and better understood growth algorithm. The Bowlero stock does currently have 6 unanimous buy ratings, and the average price target comes in at $19.60 for an upside of 67% from current prices. Down below, our most recent ratings came in just this past week, both with upsides of 62%, and our high-end price target is from Jefferies with an upside of 113% and a low-end price target still at 45% upside. Our third strong buy small cap stock is a company called Cellebrite. Trading under the ticker CLBT, they're currently priced at $10.76 per share. You can see they did take quite the dip following their SPAC merger, getting down to about $4 per share, but have been climbing back since. In the past year, they're up 103% and have gained nearly 14% in the last 3 months. Cellebrite is involved in digital intelligence for law enforcement and forensic investigations. With more and more states passing laws mandating increased oversight, Cellebrite aims to take advantage of this, giving law enforcement greater resources to collect and analyze digital evidence while creating and maintaining an electronic trail for regulatory overseers. They give law enforcement a range of products designed to give them the tools they need for proper collection, review, analysis, and management of digital evidence. Founded back in 1999, over 5 million investigations have used Cellebrite solutions. They'll be sharing their Q1 earnings report in about a month's time on May 23rd. And once again, we have a company that in their last quarter came out with a wider than expected loss, but they did come out with some record revenue. For their Q2, analysts will be anticipating earnings per share of 2 cents. This does follow a loss of 8 cents in their fourth quarter. But for their fourth quarter, they did have record revenue of $93 million, which was up 26% year over year, and record annual recurring revenue of $315.7 million. Just last week, Cellebrite did receive a new buy rating from an analyst at Lake Street. Behind the new buy rating, the analyst notes that the company's new case-to-closure platform, which enables law enforcement agencies to integrate data extraction, analysis, and case management in a single dashboard, is a significant enhancement on their previous offerings. They also point out that investors might be underestimating Cellebrite's growth prospects given the rising demand for digital forensics driven by an increase in digital crime. The stock comes in as a strong buy with 7 unanimous buy ratings. And the average price target comes in at $13.30 for an upside potential of over 23%. Looking at our most recent ratings here, we don't have a wide spread in price targets. They go from about 11% upside, a couple at 20%, and a high end from TD Cowen with an upside of 38%. And third on our list today is a company called Alight. Trading under the ticker ALIT, they're currently priced at $9.17, and like the others, definitely have some ups and downs over the last few years. In the past year, though, they're fairly flat overall, down 1%, and have been climbing in recent months, gaining 39% in the last 6 months. Alight offers enterprise clients a business process software product. They describe their focus as human capital, partnering with their customers so that they can reap the rewards of their benefits programs, accurate payroll, and attentive HR departments. They use data technology to help their clients connect the dots between employees' lives and works. They make their products available to client companies by subscription, turning business process into business process as a service. Using the subscription model makes it easy for their clients to adopt their software products. Alight will be sharing their Q1 earnings report in a couple of weeks on May 7th, and this does actually follow an earnings beat in their previous quarter. For their Q1, analysts will be looking for earnings per share of 13 cents, which is in line with last year's. This follows quarterly earnings of 30 cents for their Q4, beating expectations by 4 cents per share, and the company also generated robust quarterly bookings of $261 million. They had annual cash from operations increase by $100 million to $386 million, and they have $3 billion of revenue under contract for 2024. As the company works to streamline their growth, they have also been divesting parts of their business, and this caught the eye of one analyst from Needham. With the company announcing the sales of their professional services and HCM payroll outsourcing businesses, this will infuse Alight with a substantial cash sum. The transaction is valued at about $1 billion, plus an additional $200 million in seller notes, and this is seen as a step that will significantly strengthen their balance sheet. Their optimism is also reinforced by Alight's plan to allocate the proceeds from the sale towards reducing leverage, reinvesting for growth, and potentially rewarding shareholders with a return of capital. Altogether, Alight has 7 current analyst ratings, all weighing in with a buy. And with an average price target of $13, that would imply an upside potential of over 41% from current prices. Down below, we once again have a pretty tight grouping of price targets, ranging from 30%, where we have several price targets, a couple at 41%, and a couple more at 52% upside. So that is a quick look at 3 small cap stocks, all with unanimous buy ratings from Wall Street. Let me know your thoughts on these companies in the comments down below. I always appreciate hearing from you guys. And of course, please keep in mind these videos are never a suggestion to buy or sell any specific stock, so please make sure you always stick to your own investment plan. Thank you guys so much for watching. Have a great weekend, and I'll see you back here next time.